Welcome back to the deep dive. We've got the earnings call transcripts, the filings, the analyst takes, and we're here to distill it all for you.
That's right. Today we're looking at a major fintech marketplace. Q3 2025 results just dropped.
And the focus seems to be execution, stability, especially after, well, a significant transition, and looking ahead at what drives growth next.
Definitely. Our mission today is sort of unpacking that. How well did they execute? Is the leadership solid now? And what are these future catalysts they're talking about?
Well, the market seemed to give an initial thumbs up. The stock jumped pretty strongly right away.
It did, closed up over 6%. So validation of the numbers, confidence in the momentum.
Although I heard the options market was interesting. Implied volatility got crushed, suggesting maybe the whisper numbers were even higher. Like they beat, but maybe not as explosively as some hoped.
Yeah, that's fair. Expectations were clearly high going in. But look, the numbers themselves were a material beat pretty much across the board.
Okay, let's get into those headlines then.
Yeah.
What did they report?
All right, revenue, $307.8 million. That's up 18% year over year.
And how did that stack up against consensus?
Blew past it. Consensus was looking for something like $278 million to $284 million. So a really solid beat on the top line.
Okay, that's strong. Gives them breathing room heading into Q4. What about the bottom line?
Huge recovery there. Adjusted EPS came in at $1.70. Remember, last year, same quarter, they had an adjusted loss of $4.34.
Wow, $1.70 versus negative $4.34. That's quite the swing.
It really is. GAAP EPS was also positive, $2.73. And adjusted EBITDA hit $39.8 million, which is up 48% year over year.
48% EBITDA growth.
Nice.
And they achieved that alongside, what was the VMD figure?
Ah, yes, variable marketing margin. It was $93.2 million.
Okay, so for listeners tracking efficiency, that VMD is crucial, right? It's the profit pulled directly from their ad spend.
Exactly. It shows how effectively they're turning those marketing dollars into actual transactions. It's kind of the core of their marketplace engine. Seeing it that high alongside strong EBITDA is, well, pretty healthy.
And that 18% revenue growth. You mentioned this marks the 6th straight quarter of year-over-year growth.
That's right, 6 in a row. Which, in this rate environment for this sector, that kind of consistency says a lot about the platform itself, not just riding some temporary wave.
Definitely speaks to underlying strength. Now, we have to touch on the leadership situation. It was a tough quarter.
Absolutely. The sudden passing of the founder and CEO, Doug Lebda, that's a huge shock for any company, emotionally and operationally.
And yet, the results didn't seem to show any major wobble. It's quite remarkable, really. This is a lot about their bench strength, the culture, maybe?
I think so. The new CEO, Scott Peyree, he really emphasized continuity in the messaging. He talked about building on the founder's vision, operational excellence, continuous improvement, all themes that were already there.
So steadying the ship, but also looking forward.
Right. And Peyree was pretty clear about the future tech direction, too. He specifically mentioned agentic AI and LLM's large language models.
Okay, agentic AI. What does that actually mean in practice for someone using their marketplace?
Well, think beyond just comparing rates side by side. Agentic AI is about tools that can proactively figure out what you need, maybe even before you do, like a really smart digital financial concierge.
Ah, so more personalized, predictive recommendations.
Exactly. Based on your profile, market conditions, it's supposed to make the whole shopping process faster, more relevant. That seems to be their big long-term bet for transforming the experience.
Got it. Let's break down the segments. Where did the growth actually come from this quarter? Insurance looked like the powerhouse.
It really was. Pulled in $203.5 million in revenue. That's up 20% year over year, the real engine this quarter.
Was that just the big guys spending more?
Well, that's what's interesting. Management highlighted that the carriers ranked 4th through 10th in their network actually increased their spending by nearly 60% compared to last year.
60%. Wow. So it's not just the top 3 carrying the load.
Precisely. It shows broader health in the channel, validates that the recovery, or at least the spending, is pretty widespread among insurers using the platform.
Okay, good sign. What about the consumer segment?
That grew too. 11% revenue growth to $66.2 million. But the profit jump was even bigger, up 26%.
And what drove that profit leverage?
Small business. They specifically called out their investments in what they call the concierge sales strategy, basically, a more hands-on customer service approach.
And that's paying off.
Apparently so. It led to a 50% jump in revenue just within small business, and they said loans closed for their partners were up 30%. So yeah, that high-touch model seems to be capturing some valuable referral streams.
Interesting. Okay, last segment, home. the one everyone watches because of interest rates. How did it do?
Still grew. Revenue was $38.1 million, up 18% year over year.
18%. In this mortgage market, how?
Home equity, almost entirely driven by home equity products. Revenue there jumped 35% in the quarter.
Makes sense. With first mortgages basically frozen, lenders are pushing hard on AGL-OCs and home equity loans.
Exactly. Existing home sales are just stuck, right? Around 4 million units annually, historically very low. So lenders are desperate for volume and tapping existing equities where the action is, and that's what the company captured.
So broad strength across the board, really? And that clearly gave them confidence for the rest of the year. Talk about the guidance raise.
Yeah, they definitely signaled a strong finish, raised the full year 2025 revenue guidance pretty significantly, now expecting $1.08 to $1.09 billion.
Up from what range before?
Previously, it was $1.05 billion, so a nice lift.
And EBITDA guidance.
Also raised, now $126 to $128 million for the full year. And importantly, if you back out the implied Q4 numbers, they look quite manageable. Revenue around $280 to $290 million, adjusted EBITDA $29.5 to $31.5 million, sets a reasonable bar given Q4 seasonality.
Okay, let's switch gears to the balance sheet and strategy. Big news there was the new credit facility, right?
Huge. They closed a new 5-year, $475 million facility. It refinances older debt, sure, but the key thing is it removes a lot of those restrictive operating covenants they had previously.
Which means more flexibility.
Tons more financial flexibility, and they've kind of earned it by paying down debt. Net leverage is down to 2.6 times. A year ago, it was 4.4 times. That's a sharp reduction.
So what's the plan with that flexibility? What's the capital allocation priority now?
Well, the CFO is pretty clear. The default priority is still paying down debt. They cited the return there, basically risk-free, as being north of 8% given current rates on their debt.
Makes sense. Hard to beat an 8% risk-free return.
Right. But, and this is key, the new structure opens the door to other things. Share buybacks are now explicitly on the table if the valuation looks attractive.
And M&A.
Selective M&A, yes. They emphasized bolt-on acquisitions, not huge transformative deals. Think smaller acquisitions to maybe round out product offerings, maybe in health insurance, or add specific homeowner insurance capabilities.
Home insurance seems like a focus area already, organically.
It is. They mentioned VMD in home insurance is already up 80% year over year. So any M&A there would likely just accelerate what's already working well.
Okay, so we've got strong execution, a clear tech vision, more financial flexibility. But the elephant in the room for future upside is still rates, especially for that home segment. Let's talk about the refinance potential.
Right, the refinance inflection point, as they seem to be calling it. This is where the latent potential really sits.
Did management give any indication of when or at what rate level they see that kicking in?
They were surprisingly specific, actually. They talked about a refinance snowball effect, and they believe the key inflection point is around a 5.75% mortgage rate.
5.75%.
Yeah, okay.
And what happens then?
Their analysis suggests that hitting that rate level would put roughly 3 times as many borrowers in the money for a refi compared to where rates have been more recently.
3 times the potential volume. That's significant.
It's huge. That's the moment when the home segment could transform from sluggish grower to, a high-growth cash machine again.
And you can see they're preparing for it. Focusing on home equity now keeps staff and systems humming.
Exactly. And they also mention actively ramping up their overall lender network, aiming for over 1,000 clients on the platform. So when that wave hits, they're ready to handle the volume.
Smart positioning. Okay, one last operational point. Traffic sources. SEO versus newer channels.
Yeah, they were pretty candid about the SEO environment. Volatile. The quote was something like, "The era of free rent on Google is coming to an end. Algorithm changes are making it tough."
We hear that a lot across different industries.
We do, but they contrasted that with what they're seeing from LLM and AIO traffic coming from AI-driven sources.
How's that performing?
The volume is still much lower than traditional SEO, they said, but the conversion rates are apparently dramatically higher.
Higher conversion, how much higher?
4 to 5 times better was the figure they used. The thinking is consumers showing up via these more sophisticated AI interactions are much further down the funnel, much more ready to actually transact.
Fascinating. Lower volume, but much higher quality leads. That could really change the economics if it scales.
It absolutely could. It's a whole new, potentially very profitable demand channel opening up.
All right. We've covered the solid results, the strategy, the prep work for a rate turn. Now let's get speculative. Time for the segment where we explore an idea based on all this.
Okay, but first, the necessary disclaimer. This is absolutely not financial advice. We're not investment advisors. This trade idea is purely for educational and, frankly, entertainment purposes, exploring a possibility based on the call. Don't just go out and do this.
Understood. Disclaimer delivered. So what's the outrageous but plausible trade idea stemming from this earnings call?
Okay, the idea centers on that refinance trigger we just discussed, the trade itself. Long-dated, out-of-the-money call options. Think 2026 leaps, maybe.
Okay, so buying upside potential, relatively cheaply, looking further out. What's the specific thesis behind using leaps here?
The thesis is this. Right now, the market seems to value the company based on its solid, steady insurance growth and good execution, particularly in small business. That's all priced in, arguably.
Yep.
But what we think is undervalued is the explosive sort of hockey stick potential in the home segment if rates cooperate. That high-margin VMD explosion isn't really in the price today because nobody knows when or if rates will hit that magic number.
The 5.75% number the CEO mentioned.
Exactly. So the bet, the outrageous part, is timing the macro. We're essentially betting that the Fed's easing cycle gets us to that 5.75% mortgage rate, or close enough, within the lifespan of those 2026 options, say, the next 12 to 18 months.
And if that happens?
If that refinance snowball does start rolling, the jump in high margin revenue from the home segment could lead to a major step function re-rating of the stock, something much bigger than the bump we saw just after earnings. The options give you leveraged exposure to that specific quantifiable catalyst.
A pure play on that macro prediction, tied directly to management's own target level. High risk, high reward, dependent entirely on the Fed.
That's the idea. It ties the whole narrative together, the current stability, the future prep, and this big leveraged bet on rates.
Okay. Quite a scenario. So wrapping up then, the core takeaway from this quarter seems to be strong, broad-based execution, especially insurance and consumer small business. Plus, they gained significant financial flexibility.
Yeah, and that solid performance really helped calm nerves around the leadership change. It positions them well for continued growth and maybe, just maybe, that explosive upside if rates fall into place in 2025 or 2026.
So here's the final thought for you, the listener, to chew on, building on that AI traffic point.
Given those dramatically higher conversion rates, 4 to 5 times better from LLM and AIO traffic compared to legacy SEO, how quickly does the industry need to pivot their strategy, their content, their tech spend, away from optimizing for Google's old algorithms towards capturing this new super high intent funnel?
Especially before competitors figure it out and saturate that channel too. A big strategic question for the new leadership.
Absolutely.
All right, that's our deep dive for today. Thanks for joining us. Do your own research, and we'll catch you on the next one.